Welcome to the first lesson in our Investment Banking 101 course on what is investment banking. Let's begin by talking about financial firms in general. So, there are many different types of firms in finance, and we're going to look at two main classes or classifications: buy side firms and sell side firms. Buy side firms are essentially the investors. They're going to be your hedge funds, your PE firms, your mutual funds. They buy companies, trade stocks. They seek a return on investment. They invest money. They're going to essentially hire sell side firms to help accomplish their goals. Some examples of these might be Morgan Stanley's sales and trading platform that allows them to buy or sell stocks, or capital markets firms like Barclays, for example. Investment banking sits on the right side of the screen, on the sell side advisor side. They are not actually investing any capital, but they're advising the investors of capital on transactions and helping them accomplish their goals. So let's dive a little bit deeper into what investment banking really is. We're going to explore a simple analogy throughout the course, and it's a homeowner looking to sell their house. Most people would hire a realtor to help sell their home, and realtors are used to help the homeowner negotiate and close the deal. They're going to help the seller and buyer agree on terms, and they're paid through commissions and fees. They don't actually make money by buying or selling houses, they make money by helping buyers and sellers connect. Investment banking is the same. Instead of houses, investment banks deal with businesses. They'll help a business acquire another business or buy another business. Some of the things they'll do in this process is help them to negotiate, agree on price, and file legal filings. Like realtors, they're paid through commissions and fees. Let's look more deeply at acquisitions in business. An acquisition refers to a firm purchasing another firm. By doing this, the buyer, the buying firm, absorbs and controls all of the assets that the seller has. Investment banks are used here to help complete the complex process. It's much more complicated than a realtor helping two homeowners agree on a sale. Let's look at ExxonMobil's acquisition of Pioneer Natural Resources in May of 2024. Citibank and Goldman Sachs were used to complete the complex purchasing process and help the companies agree on terms. As advisors, they were compensated through fees and commissions. So, there is one more primary duty served by investment banks that we have not gone over, and that's helping firms raise money. Firms use capital in a variety of different ways: to buy new assets, to pay suppliers on time, to grow and expand the business in general. Investment banks don't provide the capital these companies seek, but instead connect them with investors and lenders. In a capital raising process, investment banks help a company sell its stock or take out a loan with another party and in exchange receive fees. One example of this service in particular is an IPO, or an initial public offering. This refers to the first time a company sells its stock to public investors. Some historical IPOs of note include Apple, General Motors, and Facebook. IPOs and capital raising more broadly will be discussed at length in future modules. So now you know the primary services provided by investment banks. We wanted to take a second here and step back and look at what's offered in this course. Investment Banking 101 is meant to be a crash course covering all things investment banking. We tailored this specifically for deeply interested students looking for a conceptual understanding of investment banking. We'll cover everything from expectations, work-life balance, and must-knows of the industry, to the functions of investment banks and key tools investment bankers use to help firms accomplish their goals. Coming up next, we'll discuss how investment banks differ by size, function, and location by looking at some real-world examples.